Hello and welcome to our Trust and Estates webinar produced by Trust and Estates and wealthmanagement.com. Today's session is titled Unique Giving Strategies to Spark Economic Development in Disadvantaged Communities, and it's sponsored by Foundation Source. I'm Susan Lipp, Editor-in-Chief of Trust and Estates, and I'll be your moderator today. In a moment, I'll be turning things over to our speaker, but first let me explain how you can get the most out of this event. To improve your viewing and listening experience, you can move your webcast windows around by dragging on the title bar or resize them by clicking on the lower right corner. At the bottom of your screen, you'll find multiple application widgets. Clicking on these icons will allow you to open and close widgets on your screen, but won't remove you from the event. A copy of today's slide presentation is available for download on the resource list widget. This webinar has been accepted for 1 CE credit hour towards the AEP designation program. The live broadcast of this event has been approved for 1 CFP board CE credit hour. Investments in Wealth Institute has accepted this program for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. Instructions for credit submittal are available in the resource list widget. For those attorneys in the audience getting continuing legal education credit, please listen for a code word that will be stated at some point during the webinar. To get your CLE credit, attorneys must put that code word into the survey that appears at the end of the webinar. Attorneys must also include their bar number and state of practice to receive the CLE credit. However, you can open the survey at any time by clicking on the survey widget on your screen. Again, please note that the code word pertains only to attorneys getting CLE credit. We welcome questions about our topic and will answer as many as we can following the presentation, but feel free to submit yours to the queue at any time. Just type it into the Q&A window on the left-hand side of your screen and hit the submit button. Please also be aware that today's session is being recorded and will be available for on-demand viewing following the event. Simply log on using the same URL that you're using today. Now let me introduce today's speaker, who is Jeffrey Haskell, the Chief Legal Officer at Foundation Source. And you can find more information about him by clicking on the speaker button at the bottom of your screen. So with that, let's get started. And Jeffrey, I'm turning things over to you.
Thank you. Hi. Welcome, everyone. Let me just say a couple of words about Foundation Source. Foundation Source is the leading provider of enterprise caliber and technology-led charitable giving solutions. At the forefront of philanthropy tech, or PhilTech, Foundation Source is the partner of choice for flexible software and services that offer end-to-end support for private foundations, donor-advised funds, and planned giving. We offer a range of purpose-built cloud-based platforms that facilitate all stages of giving and configurable suite of administrative, compliance, tax, and philanthropic advisory services for donors, nonprofits and charities, and professional advisors, including RIAs and financial institutions serving wealth management and private banking clients. With 65 years of experience, Foundation Source empowers people and companies to create a better world through philanthropy. We support more than 4,000 charitable organizations. We administer more than $25 billion in foundation assets, and we facilitate more than 120,000 grants and planned gifts annually. And with that, let's begin. Well, over the years, we've seen a remarkable evolution in the way that social issues are addressed in the philanthropic community. The old way was to simply make grants, give a needy person a fish, if you will, effectively slapping a Band-Aid on the problem rather than finding a lasting solution. The focus was on treating the symptoms rather than the root cause of the problem. However, over the last few decades, philanthropy has truly evolved. Philanthropists and charitable organizations have learned that it really is better on so many levels to teach a needy person to fish, to bring about long-term and sustainable impact by breaking the chains of dependency. This approach has been applied not only to provide assistance at the individual level, but also to rehabilitate entire communities that have been economically depressed. While economic development of a community is not a per se charitable activity, it can further any number of legitimate charitable purposes depending on the circumstances. Interestingly, legislative history and IRS guidance, including examples found in the early PRI regs from as early as the 1970s, acknowledge that assistance in the form of economic development can indeed accomplish charitable objectives given the right set of circumstances. This approach has continued to evolve, for example, in the wake of 9/11, beyond the rehabilitation of rundown inner cities to the restoration of areas damaged or destroyed by natural disasters or acts of terrorism. A cardinal rule in this area is to provide assistance only where it's needed. You need to be somewhat surgical. Therefore, if just a section of the city is run down and in need of rehabilitation, the organization shouldn't provide assistance to just any business in that city, because some areas in the city might be well off or decent. Instead, assistance should be limited to just that blighted section. And in that vein, even in the rundown area itself, assistance should be provided only to those businesses that actually need the help. So how do you go about identifying a distressed community, one that the service is also likely to consider distressed? Well, specifically, if an area is designated as underprivileged by a government entity or third-party organization, that's a strong indicator right there that the IRS would consider the area to be, in their parlance, blighted. For instance, businesses might be offered tax and other incentives if they locate to that area. And then you have the Distressed Communities Index by Economic Innovation Group. There's also the HUD, Low and Moderate Income Areas data set. And additionally, there are several federal programs that offer investors tax incentives to invest in federally designated low-income communities. But we'll touch on just two of these programs for now. One of these programs is the Opportunity Zone Tax Incentive, which provides capital gains tax relief to taxpayers who make investments in qualified Opportunity Zone property through special investment vehicles that are organized for that purpose. An Opportunity Zone is a low-income census tract with an individual poverty rate of at least 20% and median family income no greater than 80% of the area median. The other federal program covers communities in the U.S. that are designated as empowerment zones. To encourage economic development and growth in low-income communities, these communities may receive grants, tax incentives, or both. There's also a federal empowerment zone tax credit available to for-profit employers with employees who both live and work in these zones. And bear in mind that there have been a series of rulings and other IRS guidance, some of which we'll be touching on this afternoon, where the service has put a lot of stock in studies that declared or concluded that a particular area was distressed or blighted. For example, if an organization indicates on its Form 1023, its application for recognition of exemption, that it's going to engage in economic development, the 1023 instructions ask whether the area in which the organization will be operating has been declared blighted or economically depressed by a government finding, which implies that the IRS would consider such a finding to be persuasive for defining the bounds of the depressed area. Following factors have also been highlighted in various IRS rulings as telling in this regard. When you see people fleeing from an area, population flight and job loss, a high concentration of disadvantaged groups, especially in urban dense areas, old and dilapidating houses. As you look at some additional factors that the service deems to be important, note that there's another common theme, and that's the comparison of the target area to surrounding areas with respect to the rate of business failure, for example, in the Rust Belt, average median income, and rates of under or unemployment. Especially in the absence of an official government finding, a report citing statistics evidencing higher rates of business failure and under or unemployment or a lower median income in the target area in comparison with the surrounding area may be key in establishing and documenting that the target area is indeed economically depressed. And in keeping with the current trend to be proactive about social issues, let's think about and consider the fact that it's generally forward thinking to identify areas that are not yet completely blighted, again, in the IRS's terms, but are on their way down. By way of analogy, imagine there's a gigantic asteroid 500,000 miles away hurtling towards the Earth. The asteroid is very far away. A course change of just a fraction of a degree could be enough to avoid impact. In other words, what I'm saying is that it would require far less effort and resources to change the trajectory of an area that's just beginning its downward spiral than to rehabilitate a badly deteriorated area that's already in shambles. Well, now that we know how to go about identifying a target area, let's take a look at how to determine which businesses in the area would be appropriate, as recipients of assistance from a charitable organization. Look, as I mentioned earlier, it's important to provide aid only to the businesses that actually need it to avoid private benefit issues. Just because a business happens to be located in a bad area or a disadvantaged area doesn't automatically mean that supporting that business would, in fact, further a charitable objective. Let's keep uppermost in our minds the notion that providing assistance to a business is merely a means to an end, because you're not really trying to improve that business for the sake of improving the business. A foundation typically will offer assistance to a business only on the condition that the business will commit to a course of action that it otherwise would not have undertaken, like locating to the target area. In doing so, the foundation attempts to further its ultimate charitable objectives, like creating jobs in an economically depressed area, without conferring excess benefits to the business or its owners. Various rulings have focused on positive factors showing that but for the assistance, the business would be unwilling or unable to engage in the activities sought by the foundation. For example, the businesses, maybe they wouldn't be able to remain open without assistance from the foundation. Although, of course, once a business becomes self-sustaining, the assistance has to stop, which therefore implies the need for ongoing monitoring of the business's financials. Maybe the business wouldn't be attracted to the area to open a branch, but for the funding. Maybe the business wouldn't provide full or part-time employment opportunities for locals, but for the assistance. Additional positive factors involve situations where the business provide a useful service or product to the community that otherwise wouldn't be available, like a fresh produce store, a tutoring center, or a drugstore, or a laundromat. Maybe the business are unable to obtain conventional financing at reasonable rates, especially where that's because lenders find that the financial risks of running a business in the target area, they're too high. It may be that the business is owned by a minority or other disadvantaged group. Foundations, like other 501c3 organizations, are bound by the private benefit rules, which require that any benefits conferred to private parties be merely incidental. Under the IRS's two-part test, any such benefit must be both qualitatively and quantitatively incidental. Benefits to private parties will be deemed qualitatively incidental if the benefit to the public can't be achieved without necessarily and unavoidably providing benefiting private interests. And as they say, you can't make an omelet without breaking some eggs. For example, in one ruling, 70-186, an organization was formed to preserve a lake as a public recreational facility and to improve the condition of the water of the lake to enhance its recreational features. While the organization clearly provided a benefit to the public at large, significant benefits were also provided to the private individuals who own lakefront property. The service determined there that the private benefit was incidental in a qualitative sense because, you know what? It's impossible to clean up only the part of the lake that the public enjoys without also cleaning up the parts that benefit the private homeowners is really an unavoidable benefit. Benefits will be considered qualitatively incidental only if the benefit is insubstantial when compared to the public benefit conferred. So the quantitative test is a comparative test in which the private benefit is weighed against the specific public benefit that's provided. For example, in Revenue Ruling 78-86, an organization was formed to fund the costs of providing additional off-street parking for local merchants in an economically depressed area. But there, the IRS ruled that the merchants would benefit disproportionately more than the community if the plan were implemented. Now let's take a look at some of the traps for the unwary regarding private benefit concerns. First, there's the case of using a shotgun where a rifle would do, in the sense of providing more assistance than is strictly warranted by the facts on the ground. Remember, any assistance has to be narrowly tailored or calibrated to help only those that need help. In Revenue Ruling 77-111, the IRS ruled that the organization's activities were not charitable, where it was funding radio and TV ads to promote businesses in a deteriorated area. The IRS found there that the organization didn't properly limit its assistance to only those businesses in need, meaning that some businesses in the area were in decent shape and would benefit nonetheless from the ads that were run to help the businesses in that area that needed help. However, really, if you think about it, one would think that if many or most of the businesses in the area were failing, it should have been all right to provide general ads promoting the area. Perhaps if the IRS had gone further with its analysis to look at how many businesses were in the area and what proportion of them were failing, they would have come to a different conclusion. Perhaps if the IRS had found that nearly all the businesses in the area were failing, with just some few minor exceptions, it wouldn't have had a problem with ads promoting the entire area. So imagine if there were 50 businesses in the targeted area, of which 45 were failing. Would it really have been necessary to pay for and run 45 separate ads just to avoid benefiting the 5 successful businesses? Another practice to avoid is providing benefits or other incentives indiscriminately to induce businesses to remain in or locate to the area. It's important to limit the incentive only to those businesses that otherwise wouldn't have located there on their own. For example, suppose there are 3 stores in a row, a hardware store, a pharmacy, and a clothing store. And while the pharmacy is doing well, the hardware and clothing stores on either side of it are failing. Well, here it would be inappropriate to provide assistance to the pharmacy to remain open just because its neighboring businesses are failing. Lastly, there could be a private benefit concern where incentives are provided to businesses to create jobs without requiring those businesses to hire or give preference to the locals. For example, if assistance is provided to a manufacturing plant in a rundown area to create jobs, the plant should be required to use local residents to staff the new hires. Now, let's see how we can consolidate the private benefit concerns we've talked about into something of a roadmap. So this is the analysis that the IRS applies to economic development corporations to determine if they're primarily accomplishing charitable purposes by providing relief to the community's disadvantaged groups. The 3 main points on this slide are that 1, the assistance has to be calibrated so that it's provided to a well-defined area that's deteriorated or in need of revitalization. 2, the assistance has to be calibrated to benefit a disadvantaged group. This factor is especially important because it provides the nexus between the foundation's economic development activities and helping the disadvantaged in the target area. For instance, the foundation could limit its assistance to minority-owned businesses with a preference for helping businesses that commit to providing job training to locals. And 3, the assistance must be restricted to businesses in the area that either are having a hard time obtaining conventional financing or wouldn't otherwise want to operate in the target area at all. But as noted by Revenue Procedure 96-32, Even if an organization legitimately furthers a charitable purpose, it may still fail to overcome the private benefit concern if the private interests of parties with a financial stake in the project are excessively furthered. For example, let's say you have a family that controls a private foundation and the foundation is engaged in economic development, but the family also controls a private development and management company. Well, in that case, the role of the company in the foundation's economic development plan would have to be very carefully scrutinized to ensure the absence of inurement or some other kind of impermissible benefit resulting from real property sales, development fees, or management contracts. As a case in point, in Revenue Ruling 72-147, there was an organization that provided housing to low-income families, but it didn't qualify as a 501c3. Why? Because it gave preference to employees of a business that was operated by the individual who controlled the organization. Although providing housing for low-income families, that definitely does further a charitable purpose, but they did so in a way that gave preference to employees of the founder's business, and that was considered to primarily serve the private interest of the founder rather than the public. Now that we know how to identify communities and businesses that need help and how to avoid private benefit concerns, let's talk about the various forms that assistance can take in the context of economic development. So, given that a convenient one-size-fits-all solution doesn't exist in the real world, I'd like to offer a couple of general pointers. For starters, it can be helpful to meet with area residents, government organizations, and other stakeholders that are already operating in the area, because they may be in the best position, if you think about it, to identify the community's unmet needs. And because it's important for there to be a link between the type of assistance being provided and the charitable purpose being served. For example, after meeting with community leaders, the foundation may learn that there's a lack of reliable childcare facilities and a lack of job opportunities. Well, between business owners, that might indicate that the streets and sidewalks are crumbling and discouraging patrons from shopping in the area, and the lack of childcare, the community has unmet needs. Well, here the foundation could develop a plan aimed to expand the childcare facility that already exists and to provide capital and maybe financial counseling to businesses in the area to help them expand. The foundation could even provide funding to repair sidewalks and beautify the district to attract patrons. Let's take a look now at the various types of assistance that could be provided as part of a charitable plan for economic development. So addressing the needs of the community could entail formulating a plan that addresses the underlying issues on three fronts. One, providing assistance directly to the individuals that are living in the community. Two, providing assistance to local businesses. And three, facilitating local improvements that'll benefit the community as a whole. Specifically, the first element of the plan could aim to enhance the skills of individual residents. For example, one goal might be to ensure that individuals have the necessary skills and vocational training to fill local jobs created through the foundation's development efforts. In addition to subsidizing a charity's existing educational program, a foundation can run its own educational seminars and provide traditional and vocational scholarships to community residents. Although if the foundation chooses to run a scholarship program for that purpose, it certainly can, but it would need to apply to the IRS on a one-time basis to approve the scholarship program, how it's run. Then we have the idea of so-called reverse scholarships. A few community foundations in Michigan, for example, noted that when scholarships are provided to residents of an economically depressed area, the recipients often leave the area after they've completed their education, a problem known as brain drain. These foundations respond to the problem by offering reverse scholarships to graduates, whereby the foundations would provide payments to graduates to pay off their student loans in return for the recipient's commitment to stay in the community for a minimum period of time. A reverse scholarship program could be part of a larger plan to revitalize an economically depressed area and to encourage the area's residents to give back to their communities. Although these programs may financially benefit individual students, that private benefit would be outweighed by the benefit to the local community. That would now be able to count the skilled professional in its ranks. And in addition to enhancing a resident's employment prospects through educational and vocational training, financial counseling as well as guidance for finding dependable childcare and safe, affordable, and clean housing can be parts of a broader plan for a prosperous community. Now let's move one level up, as it were, and take a look at the types of assistance that can be provided to businesses to stimulate economic development. Assistance to businesses, which may include sole proprietorships, by the way, can take many forms. Which form of assistance is appropriate is going to depend on the needs of the business and the community. So, for example, an existing business may be failing not for lack of patronage or access to capital, but because of poor management and lack of general business know-how. And to address that, the foundation may directly provide capacity building support. And that can include training on management, budgeting, cash flow, marketing, and the like to help get a business back on track. This type of assistance could be considered a direct charitable activity of the foundation. Let me just address what that is in case some of you are not familiar with that term, DCA. It's that foundations are well known to have a 5% annual payout requirement, and many folks feel that that could be accomplished only by making traditional grants to IRS-recognized charities. However, that's not the case. That's not the case only. While that's true, a foundation can also satisfy its so-called annual 5% payout requirement by incurring expenses that further charitable activities, projects, or programs that it runs itself. So again, while foundations often will subsidize a program run by a public charity, foundations can choose to run their own programs if they wish to. Those programs are typically called direct charitable activities, and the expenses that are incurred collectively in running that activity, whether it's insurance, rent, wages, what have you, are aggregated and reported specially on the 990PF, because when you see a foundation with lots and lots of expenses and not that many grants, the optics can look bad for the foundation unless you dive into the return and you see, oh, wait a second, they had direct charitable activities, and here's all the money they spent running that activity. Then, of course, we have mission-related investments. In some cases, a moderately successful business may have its own plans for expansion or job creation, but it may be starved for capital. In that case, a foundation may choose to invest in or loan money to the business if doing so would further the foundation's mission and represent a prudent investment. A so-called dual return, right? You're seeking a financial return at the same time as you're seeking a social return that would further the foundation's mission. Those are sometimes called MRIs, or mission-related investments. It's not a term that's been coined by the Internal Revenue Code or the regs. It's a term that's been coined by the industry at large. And then you have program-related investments, or PRIs. So in other cases, a foundation may incentivize a business to remain open, expand, or locate to the depressed area by making what's known as a program-related investment, often referred to by the acronym PRI, the primary purpose of which is to achieve a charitable return, not a financial return, and that meets certain technical requirements that are set forth in the code. These investments represent an exception to the jeopardizing investment rules, which generally require a foundation to invest prudently. So just to put that into context for you, so mission-related investments are typically straight-up investments, although there's like a dual motive there. You're seeking two kinds of returns, where, again, on the other hand, the foundation generally is required to invest prudently, and some of these investments the foundation may wish to make, it may wish to make them to advance purely a charitable purpose. They're not interested in securing a financial return at all. It's not even like, maybe it's a very nominal factor at all, if any. And so the IRS made an exception to the jeopardizing rules, and that's what these PRIs are. Whereas a foundation, if they meet the requirements, gets an excuse that's an escape hatch from the prudent investment rules, so they can make investments that they think will provide them with a substantial social return on their investment. So, depending on the circumstances, a PRI may be structured as a loan, an equity investment, or a loan guarantee. For instance, in one PLR from 2000, the foundation provided loans and guarantees to daycare centers to enable them to build and expand child care centers. And typically, the terms of a PRI, such as a low interest loan, are designed to achieve the foundation's objective of inducing the business to commit to remaining up and running, to locating to the area, or to expanding operations and hiring additional local workers. When a foundation makes a PRI in a business concern, the business is required to furnish ongoing financial and progress reports so that the foundation can monitor if the business is holding up its end of the deal, or if it's becoming self-sustaining, making further assistance inappropriate. Where investments are made in installments, the business may be held to milestones. To attract needed businesses to the area, it may be necessary to first attract businesses that provide services to other businesses, or that may serve as an anchor to draw other businesses to the area. For example, enticing an office supply store with a copy center or a private delivery service to come to the area might make it easier to attract other businesses to the area. Let's move on now to the last level of assistance, which is assistance of the community as a whole. I just wanted to pause for a second and note that there is a word that the attorneys in the crowd will need to get their CLE. The word that you're looking for is development, as in economic development, development. Okay, moving right along. Increasing the quality of life for communities' residents can also be achieved through improvements to the area's infrastructure, housing, and child care facilities. Look, as a practical matter, a foundation should investigate whether there are any programs already being run by local organizations or the local government that are meeting at least some of the community's needs. If so, wouldn't it be more efficient to fund an existing program than to start one from scratch? So keep in mind also that rehabilitation of public works, including roads, sewers, sidewalks, lighting, and parks, can also create a positive atmosphere leading to prosperity. After all, even if the foundation's efforts is successful at creating more jobs and opportunities for self-improvement, who would want to live in an area and bring up a family in a neighborhood with crumbling streets, cracked sidewalks, burned out streetlights, and rundown playgrounds? An extension of improving the community's infrastructure is the provision of safe, clean, and affordable housing. In some rulings, the IRS-approved construction or acquisition and renovation of housing facilities. Typically, this involved renting or selling such housing below cost to low-income families that otherwise wouldn't have been able to afford to purchase these homes. It might have been also they provided down payment assistance in some cases and various educational courses to prepare new home buyers. As we'll talk about in a bit later on, when combating community deterioration is a charitable purpose that's identified as one of the purposes being served, assistance doesn't have to be limited strictly to low-income individuals. I'm just going to go on to say that establishing or expanding a child care facility or a community center could be the cornerstone of a plan for improving the community, turn things around. Not to be overlooked, part of a plan for rehabilitating a community is making essential services available to the residents. For example, in Revenue Ruling 72-559, in the interest of making legal services accessible to residents of an economically depressed area who had little access to such services, the IRS ruled that an organization could provide subsidies to graduating law students so they could start and maintain a law practice there. Note that most of these activities can be run directly through the foundation, again, as direct charitable activities. They don't necessarily need to be run by public charities. So now we know how to identify target areas and businesses that need assistance, and we know how those needs can be addressed. But let's talk about why the IRS treats these activities as charitable in the first instance. The elements of an economic development program can come in many shapes and sizes depending on the needs of the community. Economic development can further many of the different charitable purposes that are listed in the Treasury regulations, including the relief of the poor and distressed or the underprivileged, the advancement of education, the erection or maintenance of public works, the lessening of the burdens of government, the lessening of neighborhood tensions, the elimination of prejudice and discrimination, and the combat of community deterioration and juvenile delinquency. Over the next few slides, we'll focus on the specific charitable purposes that can be furthered by a carefully structured economic development program, which could include job creation, safe and affordable housing, assistance to businesses, and the rehabilitation of a depressed area. As we go through these slides, you'll notice a significant overlap in the charitable purposes being furthered because the ultimate beneficiaries of these programs, the members of the community, are the same in all cases. Job creation is an important factor in determining whether a foundation's economic development activities are actually furthering charitable purposes. As I've mentioned, the reason this factor is so important is that it directly links the foundation's economic development activity with the purposes of providing aid to the poor and distressed, reducing dependency, and reducing community tensions. Let's look at a few rulings where the foundation's activities were aimed at job creation. First, there's a PLR 1999-43044, where the foundation's primary purpose was to promote economic development in underdeveloped and disadvantaged areas. The foundation accomplished this by investing in new and existing for-profit businesses in a depressed area to create jobs for and underemployed residents. There, the IRS concluded that the loans and grants by the foundation were intended to create jobs and otherwise combat community deterioration in a targeted area, and therefore were approved as charitable activities. In Revenue Ruling 74-587, a pretty major ruling, an organization provided funds to sole proprietorships who were unable to obtain funds through traditional or conventional means due to minority ownership or the depressed nature of the area. The organization there gave preference to businesses that provided training and employment opportunities for the or underemployed. There, the IRS concluded that the organization's activities would help lessen prejudice, relieve poverty, and lessen neighborhood tensions. We have Revenue Ruling 76-419 as well. Here, the IRS granted exemption to an organization that purchased blighted land in an economically depressed community. It converted the land into an industrial park, and it induced businesses to locate new facilities in the park through sweetheart lease terms. These terms required the businesses to provide employment opportunities for under and unemployed residents of the area, and the organization gave priority to tenants that agreed to hire low-skilled workers and to provide job training to the area's residents. Now let's take a look at how the provision of housing can further charitable purposes. Facilitating access to safe, affordable, and clean housing is another important factor in determining whether a foundation's economic development activities further charitable purposes. Making safe and affordable housing available directly, again, links the foundation's economic development activity to aiding the needy, combating deterioration in the community, and reducing community tensions. Here, too, it'll be useful to cover a few rulings and revenue procedures to illustrate how the IRS views these factors. Well, at first glance, it may seem as though relief for the poor and distressed would be the only justification for providing safe and affordable housing. However, the fact of the matter is that relief for the poor and distressed is only one of several levers that might be served charitable purposes. Other charitable purposes advanced could include relieving neighborhood tensions, combating community deterioration, and relieving the distress of the elderly or physically handicapped. In these cases, assistance need not be limited to low-income individuals. Section 6.01 of Rep. Proc 96-32 reinforces the notion that relief for the poor and distressed isn't the only charitable purpose that can justify housing assistance. Referencing Revenue Ruling 70-585, the revenue procedure cites combating community deterioration as yet another justification for economic development. The IRS specified that constructing or rehabilitating housing has the potential to combat community deterioration, provided that the organization operates in an area that has actual or potential deterioration, and the activities being conducted prevent or relieve community deterioration. Now, Revenue Ruling 70-585 addresses 4 different scenarios. In one of the scenarios, housing units were sold at or below cost to low and moderate income families who are unable otherwise to obtain housing due to discrimination. The IRS concluded there that this was a charitable activity because it was designed to eliminate prejudice and discrimination and lessen neighborhood tensions. Another scenario addressed by Revenue Ruling 70-585 involved a badly deteriorated apartment building located in an area where the median income level was lower than in other parts of the city. As part of an overall plan for renewal of that area as a residential community, the apartment was renovated and rented at cost to low and moderate income families with a preference for area residents. This was considered a valid charitable activity, even though the units were also made available to moderate income families, because the charitable purpose furthered was combating community deterioration, not just relief of the poor and distressed. And finally, by contrast, in yet another scenario addressed in the same ruling, in an effort to alleviate a housing shortage where units were constructed and rented out at cost, but only to moderate income families, it was ruled that no charitable purpose was being served because it didn't provide relief for the poor, it didn't lessen prejudice, reduce neighborhood tensions, or combat community deterioration, or serve any other 501c3 purpose. But let's take a look at the charitable purposes that can be served by providing assistance to businesses now. Although businesses are not proper charitable objects in and of themselves, I alluded to that earlier, they are nonetheless the instruments for accomplishing the charitable purpose. The justification for carrying out charitable activities through a non-charitable instrument like a for-profit company is mentioned a number of times in the examples found in the PRI regulations and in other IRS guidance. As you can see, a number of the charitable objectives furthered here are the same ones furthered by other economic development activities that we've already covered. I like to point out that the authors of a 2003 exempt organization CPE white paper on disaster relief observed explicitly that aid to a business run as a sole proprietorship can be seen actually as relief to a needy and distressed individual, because under this approach, you look through the business to the individual who would otherwise be unable to earn a livelihood and provide for his or her own basic necessities. Finally, let's move on to rehabilitation of a depressed area. Several of the original PRI examples demonstrate that rehabilitating a downtown area that's run down, dense urban area furthers a charitable activity. And one of the examples added just a few years ago to the regs, on the PRI regs, explicitly addresses the rehabilitation of the community's business district in the wake of a natural disaster. In fact, the 2003 CPE text provides the following example. It goes like this. A community central business district is severely damaged by a tornado. Because of this devastation, the district has become blighted, and no single business is willing to begin restoration efforts without assurance that the business district as a whole would be restored. No one wants to go first. In this instance, it would be appropriate to provide assistance to combat community deterioration because without the assistance, the district likely would remain blighted. Another aspect of community rehabilitation is the erection or maintenance of public works. Now, to steer clear of private benefit concerns, public works should be made widely available to the entire community and not enjoyed chiefly by a specific group or private interest. Another charitable-based basis listed in the regulations as lessening the burdens of government. In determining whether an activity can be considered to lessen the burdens of government, the following two-part test is applied. Is a proposed activity actually a burden of government? Like, do they think so? I mean, you might think so, but do they regard this as like something that they're obligated to do? And secondly, will the foundation's proposed economic development activity actually lessen that burden, right? So this is a difficult test to meet because you have to do more than just show government enthusiasm or praise for a project. The IRS looks at the facts and circumstances to make a determination, including whether the activities are currently or were previously conducted by a government unit, whether the project would in fact defray expenses that would otherwise be paid by the government, and whether the activities could be performed directly by the government. Upon inquiry, the foundation would bear the burden of proof to show that an activity is in fact a burden of government. For instance, however, you could accomplish this by obtaining a letter from a government official acknowledging that the activity is regarded by that government unit as a burden of government, especially when the government never has conducted and is not presently conducting that activity. You really might need something like that. Look, now that we've covered the substance of how economic development can further multiple charitable objectives, let's turn to a couple of case studies. The foundation identifies a blighted area suffering from rampant unemployment, lack of affordable, safe, and clean housing, failing businesses, population flight, and high levels of community tension. What can the foundation do about that? Well, the foundation certainly can meet with local residents to get the ideas of where they think they have unmet needs. That's something we've talked about. They can certainly provide low interest loans, loan guarantees, and financial counseling to the struggling businesses. And again, where it's in the form of a PRI, I didn't mention this earlier, but special oversight is going to be referred to as expenditure responsibility to avoid a penalty. Another thing they could do over here could be to repair the sidewalks, the lampposts, and the roads that are in the area. Let's go to the next case study. Now, here, the foundation knows several local businesses that are on the brink of bankruptcy, and massive layoffs of local workers are in process. Some of the local businesses are starved for capital because they were unable to obtain conventional financing, and others are potentially profitable, but simply are not being run efficiently. So what can you do about that here? Well, is this okay? Is it not okay? Can you provide all those that kind of help? So I'd say the answer is we don't have enough information yet. With the businesses that we're talking about, would they have moved there anyway on their own initiative? We don't know. Is the business required to hire a minimum percentage of local residents? Is there going to be any kind of preference for providing a residence, again, that are maybe low skilled, like one of the examples that we covered earlier, or that or willing to undertake training? And the foundation should require the businesses to employ a significant percentage of area residents as a term under the lease, in theory. So these are all ways that a foundation can go about helping. And these are all the things the foundation can do to help. And again, the same issue over here, the purchase and renovate the commercial building, is that okay? And again, a significant number of jobs, but where are those jobs located? You don't know. It might be, what if you open up a store and you're hiring people from outside the community? That's not going to help the community nearly as much as if you committed to hiring people inside the community. So now I think we have time to take some questions, if anyone has them.
Okay, yeah, let's move on to the questions. And feel free to submit any you have in the queue. Okay, you mentioned that a foundation can provide support directly to individuals in disadvantaged areas. Are there any special procedures that must be followed for PF to do so, or can it just go ahead and make those grants?
So it really depends on the nature of the assistance that they're providing to the individuals. So if the foundation, for example, were to hire trainers and rent space, and everyone is welcome to attend. There's no charge, no cover fee. Foundation certainly could host seminars of some sort for training of anyone who first come, first serve. That would not require IRS approval. However, if the foundation were to undertake to select certain individuals and provide them with scholarships, and again, when we say scholarships, we're talking about scholarships. We're not talking about necessarily only going to a school. It could be like an apprenticeship or an internship or a vocational school to learn how to be a welder, for example, or to learn any number of skills, to be an electrician, whether or not it involves formal schooling, but some sort of apprenticeship. But where the foundation is doing that and covering individual costs, the IRS requires the foundation to apply, and the foundation could do that with its 1023 application for recognition of exemption, or it could do any time down the road where it crystallizes its plans. The foundation would need to explain how they're selecting certain people for benefit for receiving scholarships over others, because again, the IRS is going to want to see that the foundation is helping individuals in some sort of fair and even-handed way with no discrimination. So yes, the foundation can help individuals. Sometimes you will need to apply for IRS approval, where they're paying for a person's education, they're selecting the particular person, but not where they're providing some sort of training or webinars or seminars open to the public at large.
How does a foundation go about establishing a direct charitable activity of the foundation?
Yeah, so we've touched on direct charitable activities a bit here and there. So I'd say the prudent thing to do would be to have a board meeting, and that someone should write up exactly what the direct charitable activity is, what it entails, what goals are attempting to be met, how success would be measured, monitoring activities. And I think that should be written up and adopted as an activity of the foundation, ideally by the board. I'm not saying they have to do that, but that would be, I think, an optimal way of going about it. Because then you could, if need be, if you're the foundation or audited, it could show that it considered all these objectives, and this is the motivation for the economic development activities that it's undertaking.
Given the concerns surrounding private benefit, if a foundation engages in any of these activities in support of economic development in a disadvantaged area, is there anything special it needs to report on the 990 PF to show that such activities didn't result in private benefit?
So I guess the answer there is maybe. So if their foundation is making a grant to public charities that are already on the ground, that are operating there, and the foundation wants to help those charities expand their operations or their activities, the foundation will be reporting on its tax return grant to those organizations as it normally would on the 990 PF. And generally, the 990 PF would say, who are you funding, what's the name of the organization, and what is the amount of the grant, and what was the purpose of it, and maybe you would disclose it there. As I mentioned earlier, if there's a direct charitable activity involved, the DCA, those are aggregated and reported in the middle of the return. Go and find it. And if there is a program-related investment, that would also be specially reported. First of all, it would not be lumped together with the foundation's other, what I would call straight up investments, but there's a specific area on the balance sheet where you're breaking out what I would call charitable assets. And the important thing about those charitable assets is that when you're calculating the foundation's annual minimum payout requirement, the 5% payout requirement, you're not taking into account the value of those charitable assets. Also, there's a place on the foundation's return where you're reporting the program-related investments that you made during that tax year. So grants to organizations for the specific purpose of economic redevelopment, direct charitable activities aimed at economic development, and program-related activities will be reported in various areas for that purpose as well. That's how I would go about doing this. If it's a mission-related investment, I don't think it would be reported specially. It would just be lumped together with the foundation's other, blue chip stock or other private investments.
All right, well, it looks like those are the questions for today. Let's conclude by thanking our speaker, Jeffrey Haskell, for his outstanding presentation, and also to thank Foundation Source for sponsoring today's forum. Once you leave the event, a short survey will pop up in your browser window, and we'd appreciate if you would share your feedback on the event. Also, if you're an attorney and you want to get CLE credit, don't forget to put in the code word that Jeffrey mentioned earlier so you could get your credit. On behalf of Trust and Estates and Wealth Management, have a great day.